Hey, welcome to assignment 2. We are going to do a little bit more on the capital side of corporations, and the first exercise we're going to do is dealing with journal entries and how to record this. You didn't need to see that, did you? Okay, I'll quit playing around here in a minute. Okay, so we've got 1, 2, 3, 4, 5, 6, 7 journal entries to record. And they're really easy, and I've laid them out so that you know what accounts you're going to credit and debit, or debit and credit, whichever way you want to look at that. So let's look at the first transaction, and it's a mouthful. It says they declared a cash dividend on the 4% 102 par preferred stock. There were 105 shares outstanding. Then they declared a 55-cent share dividend on 95,000 stocks of common stock outstanding. And then they give you the date of record, which is January 31st, and when it's going to be paid. The only date we're worrying about right now is the January 31st. So let's kind of look at these numbers. First, you have the preferred stock. And now the preferred stock is simply a very easy calculation. It's going to be, we're just going to, I'll put it down here, okay? Preferred stock is 1,050 times 102 times the 4%. And that's how much the dividend is. And that's a payable. That'll become a payable. Because it's not being paid, we're just declaring it right now. So that's your preferred stock. And I believe that comes to 42.84. Now, your dividends payable for common is really easy because you're just multiplying the number of shares, which is 95,000, times 0.55 or 55 cents. And then that becomes to 52,250. Now you can do your retained earnings, because when you declare dividends, it comes out of retained earnings, which is the holder of net income. So you add these two together, and you're going to debit your retained earnings for 55,534. And that is your first entry. And we're looking at dividends being paid now. Now you're going to come down and pay them. Well, you're just going to kind of reverse that, except for instead of retained earnings, now you're going to credit cash, which is what you're paying, right? And you're going to debit the preferred and the common stock. So then they split, and they now have 190 shares, 190,000 shares of $5. That's their par. It was at $10 par, and they divided it in half. And now they have 190 shares outstanding. And they got that 190 by multiplying that 95,000 by 2. Now, this is just a memo or memorandum that's put into the journal so that they know when they split the stocks. That's all you have to do with that. And then along comes July 30th. What did we do on July 30th? We distributed a 25% stock dividend on common stock, and the market value was $10 per share at the time. So what do we do with that? Well, we've got to, it's a stock dividend is very similar to a cash dividend, only you don't give out cash, you give stocks out. So let's kind of look at that. So here we go. Now we are going to figure out how much all of this was worth. You'll notice there's no cash here. What we're trying to decide is how much we need to take out of retained earnings. So if we look at this, you have 190,000 shares. The market value is 10, and you're distributing 25% of that. So that is your benchmark. That's how much would come out of retained earnings. So now you're going to multiply that out, and you'll come up with $475,000, which is a sizable amount of money. Now, okay, now let's step back a second. This is the amount that the value of that dividend, those dividends. But that's not the value of the stock that you have. The par on that stock, remember, is $5 right here. So we're going to have to break this down. So we're going to have to do 190,000 times the 25% times the 5, which gives you, this is what you're handing out or you're using for a stock dividend, which is going to give you $237,500 in the par value of that common stock. Then the rest of that amount goes into the additional paid-in capital in excess of par. So that's really handled just as if you were selling the stock. The only difference being you're distributing the stock to people who already have stock as a dividend, and that comes out of your retained earnings. Now let's look at, now we're going to do some stuff with treasury stock. And treasury stock is nothing more than stock that we've bought back. And we buy it back off of the market to either prop up our price, or to, it's really low, it's a good buy, we'll invest in it, and when the market price goes up, we'll sell it again. Or we may use that as benefits for officers in the organization. So we purchased 3,000 shares of treasury stock at $15 a share. What does that look like? Well, the cash, we know. You're just literally going to, how much cash did you put out? Well, 3,000, right? Times 15. So we know that's going to be a credit to cash, and treasury stock's going to be debited for that amount. Treasury stock actually subtracts from common stock, so it's going to have a debit balance. Now, on November 8th, I think we sold it. November 8th, we sold 1,500 shares of the stock for $20 each. Now, this becomes very important here. We bought it for 15, so in essence, that becomes its par value. So now I'm going to sell 1,500 of them, was it? Yeah, 1,500 at $20. So I know what my cash is going to be. I'm going to get $30,000. That's a good thing. My treasury stock, though, is going to be debited only for the amount of the par. So now we're looking at 1,500 times 15, and that's $22,500. The additional money, or the additional amount of the sales, goes into paid-in capital, because this $15 was par, and we sold it at $20. Now, it really gets tricky with the next one, because we practically give this away at $9 a share. We sold it 1,500 of them for $9 a share, which, as I said, is practically giving it away. So we only received $13,500. Whoops, I need to get over where I belong. So I'm going to debit my cash for $13,500. Now we've got something really tricky going on here, because I'm below par, aren't I? So that means that I'm going to have to somehow make this work. My treasury stock is in there at $22,500. That's what it has to be credited for. We now have to balance this out. I have paid-in capital associated with that treasury stock that I can remove, that I'm going to have to remove, and I still do not have enough to cover that difference. So I'm going to have to remove it from retained earnings. The remainder has to come out of retained earnings, which is $1,500. So that's literally a loss. Probably that would look better down here. We gained it here with this. We lost it here, and then we literally had to go into retained earnings and remove some to balance that transaction. So that is how you record treasury stock, a stock dividend. You've done it all. A regular dividend, and a preferred stock dividend. So you've done all of the dividends in one activity. Now we're going to look at earnings per share. And this is kind of fun. They give you all kinds of numbers here. So earnings per share, the calculation is net income minus preferred stock dividend divided by the average common stock. So that should keep that in mind. So we've got 40,000 shares of common stock outstanding. So that's what we're going to divide by, okay? Let's just put that in there so we can remember that, because otherwise I'm going to forget it. So what's my income from operations? Well, it says it's 104,000, and I have, this is not very well explained, but this 30,000 shares of $2 preferred stock, that is supposed to be telling you that's their dividend. So that's minus 60,000, and that then gets divided by 40,000. And that will give us our net earnings per share from operations, and that's $1.10. And then we had a gain from operations, discontinued operations, and that was at 20,000. That's divided by 40,000, and that gives us 50 cents earnings. And then I had earnings before extraordinary, an extraordinary gain, right? Income. Oh, wait a minute. They want us to add this up. There you go. Sorry, I got ahead of myself. So income before extraordinary items, we made $1.60 per share. Now we have an extraordinary gain to add on to there, which was $10,000. Yes. And we're going to divide that by 40,000. And that is going to be 25 cents. So, all told, put together, net income, we made $1.85 per share. So now you have figured out how to do dividends, and now earnings per share. And then they ask about a method of how to show appropriated retained earnings. And I'm going to let you go to the book for that one. That's pretty explicit. There's 2 ways of doing it, so you can tell me how that goes. Have a good day.